Hello everyone. We're from Group B. We're going to present about depreciation, impairments, and depletion. Before we present it, I will introduce my group members. There is Janice, last digit MPM 251, Talitha with last digit MPM 258, Ignatius Ardino Miskha with last digit MPM 121, and Prita Luneta K with last digit MPM 171, and me, Nabilah Nur I with last digit MPM 096. At first, I will explain about depreciation. So, what is depreciation? Depreciation is a systematic allocation of the cost of a long-lived asset over its useful life. It is not based on change in market value, but on the matching an asset cost with the revenue that help it generate. So depreciation have two concepts. This is depletion. It's depreciation that relate for natural resource and amortization that relate for intangible asset. So how to calculate depreciation? There is three key concepts. The first one is depreciation base. It's mean calculate that use cost minus residual or salvage value. The second is useful life. It calculate that estimate period the asset will provide the benefits. The next last is depreciation method. It means approach used to allocated costs. The next is the method of the depreciation. The first one is the activity or unit of production. It method allocate cost based of the usage or the output. The second is the method called the straight line method. It method that spreads the cost evenly over the asset life. And the last is accelerated method or sum of the year's digit and declining balances. It's method that record higher depreciation in the early but lowers the amount later. It method that reflecting higher productivity or efficiency early on. Overall, depreciation is unsure that expenses are recognized or fully over time and help provide a more accurate measure of profit and asset value in financial statement.
Hello everyone. Today I will explain about initial cost allocation in asset accounting. So first, let's talk about component depreciation. Under IFRS, important part of an asset must be depreciated separately because each part has a different useful life. For example, in an airplane, the airframe lasts 20 years, the engine lasts 8 years, and the seats last only 5 years. Because of this different useful life, company calculate depreciation for each component separately, and the journal format entry is like debit for the depreciation expense and credit for accumulated depreciation. And now let's move on to partial period depreciation. Assets are usually not always purchased or not purchases on January 1st. Sometimes companies buy assets in the middle of the year, so depreciation must be adjusted based on how many months the asset is used. The formula is full year depreciation multiplied by month used divided by 12. For example, 9,000 times 9,000 times 7 over 12 equals 5 5,250. This means the company records depreciation for only 2 months use. That's all for the slide 1. So I will explain the second slide. So in the slide is talk about estimate, revision, and economic reality. The first one is revision of depreciation rates. Sometimes companies change estimates about useful life or residual value. Under IFRS, these changes are applied prospectively. This means companies do not correct past record, but they only calculate depreciation again for future periods. The new depreciation formula is remaining carrying amount divided by remaining useful life. For example, 45,000 divided by 20 years equal 2,250 per year. Next is the cash of misconception. Many people think depreciation creates cash for replacing assets. Actually, this is not true because depreciation is a non-cash expense. It reduces net income, but there is no cash outflow when recording depreciation. So depreciation affect accounting profit, not cash directly. Lastly, I will give a quick reference table on the corner. It tells about the key rules. First, component depreciation means different parts have different useful life. Partial period depreciation is prorated based on month use. Depreciation does not create cash, and change in estimate are applied prospectively.
Okay, for the next material, we will talk about impairments. The general accounting standard of lower of cost or net realizable value for inventories does not apply to property, plant, and equipment. Why? Because unlike inventories, it is difficult to arrive at a fair value for property, plant, and equipment. That is not somewhat subjective and arbitrary. So we go to the first, recognizing impairments. So a write-off is when a company reduces or removes the value of an asset because it is no longer expected to generate enough economic benefit, often due to losses or unfavorable market conditions. These write-offs are referred to as impairments. To determine whether an asset is impaired, companies annually review the asset for indicators of impairments. That is, a decline in the asset's cash generating ability through use or sale. So, if impairment indicators are present, then an impairment test must be conducted. To next, we will still talk about recognizing impairments. So, if the carrying amount is higher than the recoverable amount, the difference is an impairment loss. So, if the recoverable amount is greater than the carrying amount, there is no impairment is recorded. Okay, we have three kind. The first one is recoverable amount, fair value less cost to sell, and value in use. The first one is recoverable amount. So this defined as the higher of fair value less cost to sell or value in use. And the second one is fair value less cost to sell. Means what the assets could be sold for after deducting cost of disposal. The last one is value in use. The present value of net cash flows expect from the future use and eventual sale of the asset at the end of its useful life. And this is the like the flow. So the current amount compared to recoverable amount to higher of two to fair value less cost to sell or to value in use. So if either the fair value less cost to sell or value in use is higher than the carrying amount, there is no impairment. If both the fair value less cost to sell and value in use are lower than the carrying amount, a loss on impairment occurs. Okay, I will also explain the condition when is no impairment and when is impairment occurs happen. So when no impairment, when the re- recoverable amount is higher of value in use of fair value less cost to sell is greater than the equal to the carrying amount, and the asset value is still justified, so no loss recorded. So the next is impairment. When is impairment occurs? When the recoverable amount is less than the carrying amount and the asset is overlooked to record impairment loss. So this is the notes. An impairment loss is reported in the income statement under the other income and expense. To reduce the assets carrying amount, the company either credits the equipment account directly or credits accumulated depreciation equipment. This is the example. The example is pharma company is testing a machine for impairment at the end of 2020 and 22. The machine has a carrying amount of $200,000 and 5 years of remaining life. Since no reliable market value is available, the company estimates its recoverable amount using value in use, based on future cash flows of $40,000 per year. A $10,000 residual value and an 8% discount rate. So this is the how we calculate in value in use computation. So present value of 5 annual payments of $40,000 is like this, goes like this, and the result is uh 100 166 M.514.20, and this is the computation of the impairment loss to machine at the end of 20 and 22. The carrying amount of machine before impairment loss is we use the $200,000 and then minus with the value in use related to machine. So this is the loss on impairment. And the last one is records an impairment loss at December 31st, 20 and 22 as follows. This one, this is the journal entry, loss impairment in debit side and accumulated depreciation, machinery and credit side. The amount is same as the loss on impairment. So the carrying amount of the machine after recording the loss is 166.514.20. Okay, we will next for the next material is reversal of impairment loss. After an impairment loss is recorded, the asset's new carrying amount becomes its recoverable amount. Even a later period, the recoverable amount increases above the carrying amount. The impairment loss can be reversed. Okay, to illustrate this reversal of impairment loss, assume that Tan Group purchased equipment on January 1st, 20 and 22 for $300,000 with a useful life of 3 years and no residual value. Its depreciation and related carrying amount over the 3 years is a follow like this. So like with the $300 that we already purchased, we divided by 3 because the useful life of the equipment is 3 years. So the explanation goes like this. On the 2022, the carrying amount is to $200,000 and the second year on the 20 and 23 is $100,000. So at December 31st, 20 and 22, TAN determines it has an impairment loss of 20 $20,000. The loss on impairment is on the debit side, and accumulated depreciation account is on credit side. The amount is $20,000. Okay, the next is tense depreciation expense and related carrying amount after the impairment is an indicate below. So after we know that we have lost $20,000. So we $200,000 minus with $20,000. The result is $180,000, and we divide it with two because is the remaining of the useful life is 2 years. So the result is $90,000, and the 20 and 24 is zero, same as before. So at the end of 2023, TAN determines that the recoverable amount of the equipment is uh, 96 $96,000, which is greater than its carrying amount of $90,000, because it's $90,000. We plus with $6,000. So the accumulated depreciation equipment is on the debit side, and recovery of impairment loss is on the credit side. The amount of $6,000. Okay, for the next, we talk about cash generating units. A cash generating unit, or CGU, is a group of assets that work together to generate cash when individual assets cannot do so on their own. So the companies use a CGU for impairment testing when cash flows from assets are interdependent. The example is Santos Spa. The machining division and packing division rely on each other to generate revenue, so they are treated as one CGU and tested together for impairment. The next material is the last material of impairment, which is impairment of assets to be disposed of. So this happens when a company plans to sell an impaired asset. Instead of using it, the asset is reported at the lower of its carrying amount or net realizable value or fair value less cost to sell. The example is when Kroger recorded impairment losses on assets it planned to sell. These assets are not depreciated, are valued at the lower of cost or net realizable value, and are revalued each period. Any gains or losses are reported in other income and expense account. Okay, this is the same as before, like the step, the flow of impairment test. Recoverable amount less than current amount. If it no, there is no impairment. If it yes, this is there is impairment. So measurement of impairment loss. We have two kind: assets held for use or asset held for sale or disposal. It depend on the uh, company. They want to hold the asset or they want to sell the asset. If if we decide to hold for use, the first one is impairment loss, excess of carrying amount over recoverable amount. Two, the second, depreciate on new cost basis, and the last one is reversal of impairment loss permit. So the if we decide to sell our assets or disposal, the first one is lower of cost of or fair value less cost to sell or net realizable value, and the second one is no depreciation taken. Okay, the next material will be presented by my friend.
My name is Prita Luneta K with last digit NBA 171. In here, I will explain about the depletion. So, depletion is the process allocating the cost of a natural resource to expense. So, the natural resource that using depletion, there are two. The first one is biological asset, like example is timberland, and then the second one is mineral resource. The example like oil and a mineral mining. For treating mineral research, there are two factors. The first one is complete removal of the asset, and then the last one is replacement of the asset only by an act of nature. To computing the depletion base involves three types of expenditure. The first one is pre-exploratory cost, and then the second one is exploratory and evaluation cost, and then the third one is a development cost. And then next we will talk about the write-off of research costs and depletion. So company usually compute depletion using a unit of a production method or an activity approach. Uh, the computing how to compute the rate of research cost and then how to compute depletion cost per unit is using total cost minus residual value and then divided into total estimate using available, and then we will get the depletion cost per unit. And then if we want to get the depletion, we using unit extracted multiply by cost per unit, and then we will get the amount of depletion. To journal the depletion is we need to debit inventory and then we credit the accumulated depletion. And next we will talk about the estimate recoverable reserve and liquidating dividend. So estimate recoverable reserve has happened when the company having new information or because more sophisticated production process are available. For the calculation, is remaining cost divided by the new estimated of the recoverable reserve, and then we will get the new estimated recoverable reserve. For the liquidating dividend, it happened when the dividends greater than the amount of accumulated net income. And then last in the depletion is a presentation on the financial statement. So the company should disclose the following related information expenditure. The first one is the accounting policies for exploration and evaluation expenditure, including the recognition of asset. And then the second one is the amount of asset, liabilities, income and expense, and operating cash flow arising from the exploration for and evaluation of a mineral research.
Okay, nextly is going to be me explaining things about revaluation. Firstly is regarding the core concept of revaluation itself. Firstly is choice of model where while historical cost is the traditional approach, company may elect to value asset at a fair value. Nextly is the recognition, or when a company choose to choose the revaluation model, it must adjust the asset carrying amount to its fair value and record any increase as an unrealized gain, commonly referred to as a revaluation surplus. And lastly is the reporting, where revaluation surplus is reported as part of other comprehensive income or OT and accumulate in the equity section of the statement of financial position of financial position as accumulated other comprehensive income or AOC. And there is the general rules for revaluating accounting, where accounting for revaluation follows specific rule regarding where gain and loss are recorded. Firstly is increase above historical cost, where they are reported as unrealized gain in OCI by passing net income. Secondly is decrease below historical cost, and it will recorded as impairment losses, which reduce net income and retain earning. Third is reversing previous impairment. If a revaluation increase reverse a previous recorded impairment loss, the increase is credited to net income up to the amount of original loss. And fourthly, or the last one, is reversing previous gain, where if revaluation decrease occur after a previous increase, it first reduce the existing re-evaluation surplus in AOC. Any remaining decrease beyond the surplus is recorded as an impairment loss net income. And for the example for a few re-evaluation is, firstly there is the re-evaluation of land or things that are non-depreciable, as you can look in here. And for the disposal itself is, if the land is sold at its carrying fair value, no gain or loss is recorded in net income at the time of sale. The remaining re-evaluation surplus in AOC is transferred directly to retained earning to eliminate the balance. And after the thing for the non-depreciable, there is the evaluation of depreciation asset, where asset like equipment, the process involves two steps at the end of the period. Firstly is recording the depreciation itself, where it records the standard of depreciation expense based on the current carrying amount. Secondly is the adjustment to fair value, where after depreciation is recorded, the asset carrying amount or the cost accumulated depreciation is adjusted in its new fair value. Next. Right. Nextly, I'm going to be explaining about the report and analyzation of property, plant and equipment, and also mineral resources. Firstly is regarding the presentation of PPE and mineral resources. Company itself must provide comprehensive disclosure to ensure financial statements are relevant and representative value. And by this, the basis of the valuation from the company is to disclose the valuation basis, which is typically the historical cost. Then there is the thing regarding asset segregation, where asset used in operation must be clearly separated from those not currently employed as producing asset, such as other facility or land held for investment. And regarding liability secured by asset like land or pledges must be reported in liabilities and not offset against the asset value. And after the asset segregation, there is also the depreciation and depletion reporting, where a company use valuation account accumulated depreciation to show the original cost of asset alongside the total depreciation charge to date. And for the mineral resource part, the reduction in cost is term depletion. And after that, there is also the part of detailed notes, where financial notes often provide breakdown of asset classes and their expected useful life. After explaining about the reporting, there is also the analysis of property, plant and equipment, where there is a few formula. And first one, before that, analysis itself, it is used to specify ratios to determine how effective a company utilize its investment in the long run itself. And the first thing is asset turnover ratio, where it measures a company efficiency in generating sales from its total asset. The formula itself is net sales divided by average total asset. And for the context why it is used in the industry itself, For example, turnover vary by industry. For instance, utility like American in USA have lower ratio, where grocery chain like Morrison or GBR have higher ratio. And after asset turnover ratio, there is also rate of return asset or ROA. ROA is a comprehensive measure of profitability relative to total asset. The formula for ROA itself is profit margin on sales multiplied by asset turnover. And under the straight-line depreciation method, the ROA can appear to increase over time even if income remains constant, simply because the asset book value or the denominator decrease each year. Okay, and lastly is regarding the capital expenditure analysis, where analysts also examine I'm sorry. Let me restart. The capital expenditure analysis, where analysts also examine the sustainability and the examine the sustainability of operation by comparing cash flow to capital spending. And after that, there is also things regarding ethical and management consideration. Management decision regarding asset reporting can significantly impact the financial result. And firstly is about the revision of estimate, where changing useful life or residual value is accounted for prospectively. And lastly is regarding about earning management, because this change require less extensive disclosure. Manager might be tempted to increase estimate useful life to decrease depreciation expense and artificially boost reported net income.